Hi, good afternoon. Welcome to today's webinar on usage and impacts of indirect rates for government contractors. I'm Susan Moser with Cherry Beckert. We're happy to be presenting this webinar today. So let's get started. First, I'd like to introduce our speakers today. So as I mentioned, my name is Susan Moser. I am a partner in the firm's advisory practice, and I am the government contracting industry leader. Joined with me today is Bryn McNeil, who is a partner in our assurance practice and in our government contracts industry group, and also Eric Poppy, a senior manager in our government contracting practice. So today's agenda, we have a full list of topics that we're going to cover all around indirect rates. So we're going to quickly run through the agenda and then we'll get started. In today's webinar, both myself, Bryn, and Eric will take turns talking about different topics. We're going to tag team a little bit, so we will jump in. If you do have questions, we do welcome them. If you do have questions, you can enter them in the chat. If we have time at the end of the webinar, we will cover as many questions as we can. If you have a question and we are not able to answer it today, we will definitely follow up with you directly and answer your question. If it's a question that we think is of relevance or interest to the larger group, we will provide the answer to everyone. One of the questions we always get asked is, will a copy of the slides be made available? And you don't need to ask that question. The answer is yes, we will provide a copy. We will also record this broadcast and it will be available after the webinar for download on our website. So for that, with that, let's just run through what we're going to talk about. We're going to talk about the purpose of indirect rates. We're going to talk about composition of total cost, and there's a number of important things we're going to cover on that. We're going to talk about some indirect rate considerations, a little bit of strategy around creating indirect rate structures, everyone's favorite topic, audit considerations, and what we're hearing and seeing from auditors and common audit pitfalls and best practices. So with that, let me turn it over to Bryn to get started.
Great, thanks, Susan. So what really is the purpose of indirect rates? In general, indirect rates can be a very confusing accounting concept for government contractors to understand. There's many nuances with respect to accounting for indirect rates. However, the better understanding that your company has in regards to indirect rates and the indirect rate structure, the more indirect costs that you can potentially recoup. And it's also a better way to manage contracts and in turn, business as a whole. So it is pretty important to understand how your indirect rate structure is within the company, because it certainly makes a difference at the end of the year on your numbers.
So in regards to indirect rates, the impact that it can have on your organization really can be dependent upon the type of contract that you have with the federal government. So when the government does business with the company, a contract's awarded for some type of product or service that the company will provide. Generally, the government will have some ongoing concern to what is actual total cost of that product or service that is provided. You know, if the contract is competitively awarded and it goes out to multiple companies, the government's a little bit less concerned about, excessive price, because the market itself helps to drive down that cost and makes for adequate competition. But if you have, depending on that contract and if it is sole source or the type of award it is, there will be more of a focus on your indirect costs. And this really can also depend on the contract itself, because the contract itself could be a mixed bag of different contract flavors. You might have certain CLINs that are fixed price and some that are cost type. That could be a very exotic type of contract. It could be like fixed price with progress payments. Again, if there's a sole source and it's a large sole source for fixed price contracts that wasn't competitively awarded, there might be more of a focus on the indirects from a proposal standpoint. Also, indirects really play into any claims or requests for equitable adjustments. So really focusing in on that contract type can also impact that focus on your indirects.
Eric, I can add to that even then from an auditor's perspective, and kind of the level of risk that a company may have does vary by the type of contracts that they have. So let's say you're a company and you use primarily fixed price contracts. The auditor is going to place more emphasis on the estimating procedures that the company has in place, and then also take a look at the controls designed to ensure that the direct costs are excluded from the indirect cost pools. If you're a company that primarily works on cost plus contracts, the emphasis is going to be more on cost allowability, and if all the costs in the accounting system reflect actual costs. So companies that have a mix of both fixed price and cost plus contracts do require special emphasis on the consistent allocation of costs. So the way that the costs are allocated become more important. And then an auditor is also going to take into consideration both the cost type contracts relative to all the contracts, and then also kind of what's that mix between your government and commercial work. Certainly some impacts from the types of contracts that you have on the audit and how risk is really evaluated.
And when you're referencing audit, you're really referring to from a financial audit perspective in that case. Is that right?
Correct. From a financial statement audit, we would tailor procedures differently depending on kind of what that contract mix really is, and if it's more of the commercial versus government, and then if it's fixed price versus cost type. Okay.
I just wanted to clarify because I know later on we're going to be talking about government audits. So just to clarify. Okay, so let's just talk a little bit about composition of total cost. So while this is primarily focused on indirect costs, it's really important for you to understand the total cost. So the government is interested in obviously your direct costs and your indirect costs, and it's important for you to look at your total cost when you're looking at it from, you know, making pricing decisions and that type of thing. Eric, did you have something you wanted to add?
Yeah, so we wanted to bring up the composition of total cost because just like Susan was saying, this is really the starting point of, and well, it is, you know, composition of total cost really is your total contract cost, and a piece of that is your indirects, but both direct and indirect play into it, which will lead us to our next slide. So the composition of total cost is really broken up into two different types of costs. And we wanted to talk a moment here about direct versus indirect costs because the two play hand in hand and all come from the same information. And that this is really the building blocks for your indirect rates. So we want to make sure that everyone has the same fundamental definition. So a direct cost, when we talk about a direct cost, it really is a cost that is identifiable to a single cost objective. So it could be for a project or a customer, could be internal or external, but it's a one-for-one relationship. If you don't have that contract, you won't have that labor, and so on. An indirect cost is a cost that's identifiable to two or more cost objectives. So you can't identify what caused that cost to be incurred. Was it contract A or contract B or a bunch of different contracts? All are the reason why that cost has been incurred. So in the end, it supports multiple contracts or projects within that organization. And all of this plays into your total contract price or your project cost. So total cost, again, as you can see, is built up by those two different cost buckets of direct cost or indirect costs. And when we talk about direct costs, we give a few examples here on this slide. You have your direct labor, your direct materials, your direct subcontractors. The indirect piece, you'd have potentially fringe expenses, overhead expenses, G&A, and then you'd have your profit that you would add on to and tack on to that contract or project for your total pricing. Now, please note here that this isn't an end-all be-all of different types of costs that might be direct or indirect. You can have many flavors and types of service centers. And for the indirect side, we will get into that in a little bit more detail later in this presentation. So here we have that same slide that we just looked at before, but now with a couple of new variations. One, we wanted to call into that your total contract price should all tie back to your GL. It should all tie back to your P&L statement. So an auditor could unpack that total contract cost and be able to trace it through to identify what direct costs and indirect costs are associated to that contract. You add in your profit, and then FARB 31 also talks about the composition of total costs, also including any allocable credits that are applicable to that contract. And we'll talk about some credits here that are really more recent because of the current current business environment because of COVID-19 and PPP. We'll talk about that a little bit later. So, as Bryn was talking about at the beginning of the presentation, indirect rates themselves can be a very confusing concept. We get a lot of people all the time that will, in companies, that will call and be like, hey, I need help with my forward pricing rates. But what they really are talking about is maybe provisional rates, or they'll talk about audited rates, and they're actually talking about approved provisional rates as well. So a lot of times it really is confusing on which types of rates are used in certain situations. So we thought this slide would be helpful of walking through the rates themselves and kind of the contract year and that perfect year. So starting on the right-hand side in the gray box for provisional billing rates, we're going to start with that circle and move our way around going clockwise. So in the beginning of the year, you will actually, very beginning of the year or end of the prior year, you will submit provisional billing rates to the government. These are for just billing purposes of your indirect rates. Those are used for cost plus or T&M billings. They also could be used for fixed price contracts with progress payments. As the year goes on, you are taking your direct costs and you're invoicing and applying your provisional billing rates. Well, during that year too, you're actually incurring actual contract expenditures, and you are accumulating those into your GL and calculating your year-end rates. During your close process of the year, you then are using those rates and computing them and comparing them to your actuals. You will use that to help then create the final indirect rates that you might use for maybe a NICRA or an incurred cost submission. Those rates from the purple box going up to the blue turquoise looking box or circle you would submit those to the government as part of your indirect rate package. Again, that could be a NICRA or it could be a F&A rate, or it could be in the terms of like an incurred cost submission. Those would get submitted to the government, and you would then have an audit of those rates to get negotiated or final year determined rates or settled contract rates. A lot of times those same submitted rates are then used for forward pricing purposes, going up to the green circle. The forward pricing rates are used for estimating out year costs and out year indirects, and they could be used then, and that most current year of those forward pricing rates could then make up the basis for our provisional billing rates the next year, incorporating all those budgets. So as you can see, when you go through the rate cycle, each one kind of feeds into the next. So a couple more points on the indirect rate cycle. One, when it comes to your provisional billings, there might be a situation where you need to revise those provisional billings and submit new provisional rates throughout the year. The reason why is so you don't have, and this feeds into the orange year-end rates, you want to make sure that your invoicing, your actuals to provisionals are as accurate as possible. Sometimes if you win a very large contract mid-year, you might also have to bring on a ton more people, but your rate itself, your pool itself for your rate computation is still relatively the same. So your rate could drop, or vice versa. If you lose a contract and now you don't have as much of a labor force, your rate could fluctuate, or if you acquire another company. So you want to be monitoring your rates as the year go on to make sure there are any billing adjustments when necessary. And then you want to make sure that you know about those adjustments as you prepare your ICS. And please also note that those, once you submit your ICS or NICRA, and you submit that to the government, it gets audited and you have final settled rates. those are the rates that you would use to prepare any completion voucher or final voucher to the government.
So just a couple things, because we get lots of questions and there's always lots of confusion about what the difference is between forward pricing and provisional rates. So the couple things that I like to think about, provisional rates. So if you don't have any cost type contracts or T&M contracts that have a rate, so say you have the M in materials, and so you might have a G&A rate that's not fixed in the contract, so you might have provisional billing rates. So lots of companies, if you don't have those type of contracts, you're not going to have provisional billing rates. Forward pricing rates are most often for companies that have fixed price contracts or IDIQ contracts where they are going to be negotiating either change orders or you're using forward pricing rates to price tasks. So usually most companies have one or another. Certainly there are situations where companies have both. But we see the government using those terms interchangeably all the time, and it is confusing because they are very similar, but they're used for different purposes. Eric, anything else to add on that?
Yeah, if you are calculating forward pricing rates, there needs to be some type of consideration to out your budgets, and a lot of times you're also using maybe indices as well for any escalation that might be happening. Forward pricing rates, they do need to be consistent with your cost accounting practices. So if you are CAS covered, you need to be, of course, following those same practices. But those are probably the two biggest things. Is especially we see a lot of questions from auditors on trying to justify those out-year calculations, and that the numbers just can't be plucked out of the air. Like, you do need to have some type of support and rationale for that.
All right, now we're going to dig in a little bit and talk more about various indirect rate structures, both what should be in the pool and some base options. So I think a couple things that it's important for people to understand, that there is no one size fits all, and it's important to understand what's in your pool, but also your base composition, because a lot of times somebody will ask a question about an overhead rate. Well, there's different ways that you can establish your overhead rate, and so you can't really just look at what the rate is. You really have to understand what the denominator or what the base is. And so there's multiple ways to do things, and it's really a function of understanding your cost and what are the benefits received in terms of really establishing what is going to be the right indirect rate structure and the right composition of those indirect cost pools based on your business or various lines of business. So let's unpack that a bit.
Thanks, Susan. So we'll kick it off with taking a look at the fringe rate and sure that everyone knows what fringe expenses are. So fringe expenses are incurred for the benefit of all employees. So it's both the indirect and your direct employees. Fringe, as defined by FAR Part 31, are the costs that would include vacation, sick leave, holidays, military leave, employee insurance, supplemental unemployment benefit plans. For the purposes of being allowable and being able to be included, it's really the cost to the extent that they're reasonable and or required by law, or if you have an employee or an employer agreement or an established policy at your company. Those would all be allowable costs that we would typically see within the fringe expenses. And Eric's going to go a bit more into the fringe rate considerations.
Thank you, Bryn. So a couple things to note with fringe expenses. One, the government kind of sees this, and a lot of times your fringe rate is your least volatile, but you still need to take some strategic considerations when you look at the types of expenses that are in your fringe rate calculation. And please note also, if anyone listening, if you don't have a fringe rate itself for standalone, sometimes it is absorbed into the overhead rate, and a lot of times it also might just be allocated to other final cost objectives. So if you are sitting there going, hey, we don't have a fringe rate, we're getting panicked, don't worry. There are many ways that you can slice the fringe rate, but a lot of times it is a standalone rate, so that's why we wanted to talk about it. So again, types of expenses that you might see in there are severance pay, tuition, education expenses, employee parking, sick, vacation, holiday, all those types of costs. One question we get a lot about is bonuses, and there seems to be some confusion on bonuses when bonuses would be part of the fringe rate. If you have a bonus plan that is available to pretty much all employees, and maybe it's based off of formula or it's based off of some type of company-wide policy, those are the types of bonuses that could be included in your fringe rate pool. However, if you have a bonus plan that's just for executives based on performance, or maybe for efficiency purposes for PMs, usually those types of bonus plans would follow the employees to their appropriate indirect rate. So wanted to comment on that since we get a lot of questions on bonuses. Other times when you might have to slice your fringe rate and look at it in a different perspective is really dependent upon, your types of employees that you have and the benefits they may receive. So we have a few bullets here of different considerations, but a lot of times you might have multiple fringe rates if you have maybe say a lot of veterans, or maybe a lot of retirees, or full-time versus part-time, hourly versus salary folks, union versus non-union. Also you can have a rate depending on geographic location, maybe international versus domestic, or one state versus another. But when you're looking at your fringe rate, similar to sometimes your overhead rate too, you might want to consider separate rates if there is a distinct difference between the benefits or the people that are receiving those benefits.
Yep, and I'll just add to that. So in theory, we get asked about this a lot, and from a pricing standpoint, a lot of times companies are interested in putting in place some type of a part-time fringe pool or an SCA fringe pool. And our one caution is there are certain situations where that does make sense, but you really do need to look at how much of a driver is this relative to your overall business. If you're adding, 10 employees that are SCA or part-time and you want to establish a part-time fringe rate, it probably is not going to make much impact in the overall, and there's a lot of so you have to live with that once you get that. So we always caution people when you're looking at different fringe rates, it's really important to understand how many people does this impact and how significant is this going to have on either type of a rate scenario.
So overhead rates, moving along, overhead costs are costs that may benefit or are associated with two or more business activities, but are not really specifically allocated to any activity for reasons of practicality. In simplest terms, overhead expenses are incurred for the benefit of the direct labor employees performing their jobs. Some examples of overhead are rent, depreciation, employee recruitment and training, and general or other professional insurance policy costs, in addition to ones that we have on the slide as well. And again, Eric will go into some of the overhead rate.
Thank you, Bryn. Just like with fringe, a few things to consider with your overhead. And I'll reiterate what Bryn just said. When we can talk about overhead costs, we talk about the costs that support the revenue generating activities. This is an area that, again, you don't want to, there are times that you might want to have a separate overhead rate, but you do have to consider, again, the long-term strategic change on and impacts on that when you do create a new overhead rate. So things to consider: geographic area, product line or service. So if you have a manufacturing group versus a service group, or engineers versus architects, or something along those lines, you might have different rates. Sometimes you might want to think of the function of those employees, or who's designing. Technicians, the example here, technicians versus software designers. So a lot of times, and we see this is really common, home office versus client site or field site rates. that's a very common way to try to more accurately allocate costs. And we'll get into that in just here in a little bit more in a moment. Sometimes you might see, a vehicle rate or a machine rate that's kind of an overhead intermediary pool. But going back to that home office rate versus field site, or a lot of people use the word company site or government site, it can get pretty confusing. But when you do that, there are sometimes situations that, they're always great in theory to calculate these rates, and companies are like, oh, we'll just create a field rate. One thing that can be a little bit more difficult and hard to justify is trying to identify and silo off those costs to that field rate or that client site rate. So you got to make sure your accounting system can identify those types of costs, and you should be able to document the rationale for that allocation and how you would split. Always remember that there needs to be an equitable allocation between the two rates. So if you are considering, having a field site or government site, however you would like to call it, a separate rate from your main overhead rate or your company site rate, make sure that you can document that, you can identify those costs, and you can show that there is an equitable allocation between those costs, between those two pools.
As we've mentioned a couple of times now, bases are used to distribute or allocate the overhead costs to those final cost objectives. An allocation base that is common to all of the cost objectives or your projects or contracts, really something that's common, should be selected for the allocation of the indirect costs themselves. Although a lot of companies, I think, that we see use direct labor or direct labor and fringe as the base for developing their rates, some companies do have more complex rate structures and can even use multiple allocation bases to allocate their costs. So a couple of the other not as common, but certainly some that we do see, would be direct labor and direct labor plus fringe and an other unit of measure. And really, when we're talking about the other unit of measure, this is typically time or quantity used. So hours incurred or machine hours used. That's really a couple of examples that we're talking about there.
Yep. Hey, Brent, one other one I would add that we see fairly often and makes sense in certain situations. If you have a facility and you are housing, your employees, and that facility is getting allocated into your overhead pool, but you're also providing facilities for certain type of temporary contractors or certain staff augmentation, it might make sense to include that type of labor. They may not be on your payroll, but if you're providing the same facilities, then you need to come up with some way to allocate that. So sometimes we see an overhead base that has direct labor, but then it might also have contract labor, for example.
Yeah, thanks, Susan. That's great. The only other piece I was going to add on here, that a company can have different overhead bases for different lines or divisions of the business. So it's really taking a look at the company as a whole to see, what type of overhead rate and what kind of base would be best kind of suited for either a certain line or a certain division, kind of as Susan was also saying.
So another common way to allocate costs, and it might be between two different overhead rates or overhead rates to G&A, or if you have multiple segments, is the use of service centers. So service centers are a way to consider developing and allocating costs for the types of functions that benefit many different programs or groups. And these functions could be, IT or communications, accounting, HR, security, recruiting, those types of costs where you could potentially group them all together. You can identify and segregate them. And then you might identify a surrogate or some other way to allocate those costs to the correct multiple final cost objectives. So such as direct and indirect labor, or particular surrogate that helps to refine and gain more precision in your actual rates themselves. So here we've listed a few examples again. The really common one that we can think of is, maybe facilities and allocating that out by square footage. Other common ones that we've seen are maybe HR and recruiting out by headcount or labor costs, or user IDs. IT can get pretty creative sometimes, where you might have IT costs that are allocated by number of user logins, or if you have a company that has people have multiple machines, number of machines by each business unit. So service centers are just a great tool to allocate costs, to be a little bit more precise to your cost objectives. And typically we see it for a lot of larger organizations. One thing we will caution here is sometimes having a service center isn't necessarily the best thing or the most easily defendable. So, if you're thinking about service centers, sometimes less is more, and where less is easier to defend, and it can get very complicated very quickly, especially with some of these ERPs that make it pretty easy to set up. But they are a great tool to allocate costs at a little bit more at a finer level. Which that leads us into our G&A rate. So our G&A rate, again, real quick, these are the costs associated with general administration and overall management of the company. The way G&A costs typically are getting bucketed or getting allocated would be based off of, most common is total cost input, which in a very simple way is all costs other than G&A. Another way that companies will allocate G&A costs is based off of value added base, which those costs, that includes pretty much a TCI base less any materials or subcontractors, and that's direct materials or subcontractors. The least common way might be based off of a single base element, which might be direct labor as an example. Now, one thing I want to note here, we get questions a lot of times of companies calling in and saying, hey, we just won a new award, or we have won a few awards in the past couple of years where we have a lot of subcontractor costs or material costs, and we're worried about excessive pass-through. We're thinking about switching our rates from a TCI to a value add, which is completely fine, and it's acceptable and can be good. But just a word of caution, sometimes it is hard, though, to then identify and allocate those subcontractor and material management costs and you have to make sure you're allocating those out effectively, too. Because if you're doing that, typically you'll have a material handling rate where you have to then identify what are those costs associated with your G&A or subs. A lot of times you do get service centers also allocated to your G&A pool. And I will also note, because recently there's been an update, a lot of times exec comp impacts your G&A rate calculation. So to that note, recently DCAA provided guidance in a new MRD that the executive comp cap has actually been published for 2019 and 2020. So I just wanted to mention that briefly here. So for 2019, the amount is $540,000. And for 2020, that it is $555,000, and that is for a calendar year, so January 1st through December 31st. So again, for 19, it's $540,000. For 2020, $555,000. So going over to the next slide. So I'm going to quickly go through this slide here. We just want to bring up a few other considerations. When you're talking about G&A, it is sometimes common to see multiple business units with a individual G&A rates. So just wanted to mention that. Again, consider that material handling and a subcontractor rate if you're using a value added base. It's something, again, that we do see a lot of issues that pop up of allocating over those subcontractor material handling costs. And those are the costs that, again, are to manage the acquisition and utilization of those subcontractors and materials. You have to consider the treatment of corporate allocations. And when you do receive corporate allocations, maybe from a corporate home office, their same treatment of FAR 31 for unallowable costs needs to be considered. And there needs to be a defendable method to allocate those costs down. And we'll talk about that here in a moment. And then lastly, Go ahead.
Sorry, I didn't mean to interrupt you. I have a point, but go ahead and finish. I'm sorry, I didn't mean to interrupt.
Oh, no worries. So then lastly, just remember to include unallowable costs within your G&A base if there are unallowable costs associated to overhead pools, or they might be unbillable direct costs. Go ahead, Susan.
Yep. So one thing I was just thinking about that I want to mention. So, you know, it's a very busy M&A market in the government contract community. And so questions we get asked a lot is company A acquires company B, and just say they did that mid-year. So usually in that scenario, in the year that they acquired, they sort of keep the G&A function separate. So you know, maybe they're sort of, it's kind of as is state till you get to the end of the year. So company A has its existing G&A rate, G&A folks that support that business, and then you've got the new company that has an existing G&A, you know, group that supports that contract base. But maybe there are some executive management time that is supporting the overall organization. So that would be an example of maybe then starting for that year, there may be some corporate allocations. But when you get into integrating, then companies start looking at, should I have separate G&A rates or combined? And I think that that's really where you have to drill down and look at who's performing what function for whose benefit. So you can have separate G&A rates if they are performing separate functions, or you can consolidate those. So those are typical scenarios that we see companies sometimes struggle with, sort of thinking through and implementing that.
Yeah, and one more item on G&A, and this is just getting to G&A versus overhead. A lot of times we'll have companies will talk to us and state, you know, our G&A rate seems to be too high, our overhead rate's too high. How do we identify, and we have a few segments, how do we identify what is G&A versus overhead? And that usually is a process of going through the different types of costs, to what you said there, Susan, and identifying who is receiving the benefit and what is the driver of that benefit between those two. So there really is an exercise of walking down through those costs to help identify that. And then, you know, the last piece that we want to talk about here when it comes to the composition of costs and how you compute it is the treatment of corporate allocations. So there are three types of ways that you typically will see the allocation of corporate home office costs. That's either direct, by use of a homogeneous cost pool, or based off of a three-factor formula for residual costs. So a direct allocation is a one-for-one. Typically, you might see legal fees or insurance or some types of benefits that are directly allocated down from corporate. So if a certain business unit has to have a certain insurance plan, that will be directly allocated down. Homogeneous costs are costs that are allocated out based off some type of surrogate. So typically, that would be, you know, again, accounting, finance, sometimes legal, where you might be allocating based off of, say, revenue or payroll or something along those lines. And then the last bucket is residual costs. Residual costs are costs that you really can't identify to a segment. It really doesn't make sense to allocate it based off of some type of homogeneous cost pool. A lot of times these costs are C-suite, some corporate admin, and there you would allocate that based off a three-factor formula, which is a combination of payroll, revenue, and capital costs that you would be allocating down. So all that's outlined in CAS 403.
Okay, so let's just talk for a couple of minutes about some strategic implications to think about when you're creating or looking at changing your rate structure. So, you know, establishing an appropriate indirect rate structure, it's really more than just coming up with a rate to bid on a contract. When done correctly, it's really, you're hoping to maximize cost recovery based on truly allocating costs based on benefits received. So in order to do that, you really have to look at your contract type. So Eric touched on contract types at the beginning, but your mix of contracts is incredibly important when looking at indirect rates. So if you have, 90% of your contracts are cost contracts, then basically the government is essentially paying for 100% of your direct and indirect costs. So you really should be focusing more on the overall total cost than just looking at the indirect costs. If you have a mix of fixed price and cost type, then you really have to look at, are you incurring costs in a like manner? Are there certain contracts that really they have heavier requirements, and you need to look at that? So you really need to look at those factors. We put compliance up there because, part of what I think Eric mentioned was keeping it simple. So while it's great to come up with multiple indirect rate structures and all kinds of fancy things, at the end of the day, you have to be able to live with that. So you have to be able to, whatever structure you have and whatever you state in a proposal, you have to live with, and you have to be able to make sure that how you estimate something is consistent with how you account for it and how you ultimately close it out. So you want to make sure from a compliance standpoint, it's something that you can live with, that's allowable. If you're CAS covered, that it's consistent with cost accounting standpoint. But when done right, a good indirect rate structure is also a good management tool. It will allocate your costs, will give you good visibility. We'll be able to, you can look at a project and see all of the costs, not just gross margin. So when done right, it can serve lots of purposes. So from a management situation, you want to make sure that a lot of times we get asked to look at your indirect rate structure and help companies come up with ways to be more competitive. The thing that you have to understand is if you're going to be more competitive and you just want to set up a new indirect rate structure, are you really eliminating any costs, or are you just moving, shuffling the deck? So you want to make sure that it's strategic and it makes sense to your business to while you're moving around different cost pools, but it's going to make sense for your business. So there's lots of different ways to accomplish that, but at the end of the day, you've got to make sure you're going to come up with something that is going to make sense for your business. Yes, can give you a competitive advantage, gives you better visibility, but you're going to be able to manage your business that way as well. A couple things to consider. If you're a small business, changing your indirect rate structure is easier. And oftentimes you do need to look at whether you need to do something different if you're proposing on a new contract that's going to significantly change your business. So when you submit a proposal, you should take into consideration the impact of that award of the business. It's always a complicated question for companies when they're bidding on an IDIQ. It's $1 billion IDIQ, and you're guesstimating how much of that you ultimately will receive. But you should always consider the impact of the award of the contract. If you are a large business and you are CAS covered, if you're subject to cost accounting standards, which if you have small business awards, those are exempt from cost accounting standards. If you have a single award of more than $50 million or multiple awards of at least 7 million, 7.5 million, but combined are over 50 million, then you would be subject to full CAS coverage. If you're subject to full CAS coverage, changing rate structures is a much more significant process, and there's many additional considerations. We could have a whole another session on how to do that. You have to do it prospectively in advance. And so we just wanted to call your attention that if you are CAS covered, when you submit a proposal, you're saying, was your proposal completed consistent with your cost accounting standard, cost practices? If you are looking at changing, there are obviously additional considerations that you need to take into consideration. So we just wanted to mention that as well.
So one thing to add, Susan, is you mentioned on the previous slide, creating new rates for maybe going after a contract. If you are CAS covered, there is a requirement for consistency between your accumulated, your pretty much your accounting versus your estimating, so your accumulating versus your estimating practices. So we do get calls sometimes from people like, hey, yeah, my BD folks say that we need to drop our rates or we need to create a new pool so we can be more competitive. Please make sure that from a compliance standpoint, there are a lot more implications if you create a new rate, or if you are going through that process, and because just like Susan was saying, it really is a lot of times just reshuffling the costs, and someone else will potentially, if one rate goes down, another rate might go up because you're moving that cost over because the cost doesn't go away. So there are considerations to be made where, from a compliance standpoint, and who's going to be taking on the full burden of that cost if you are thinking about changing your rate structure.
Oh, good point. The last thing we want to talk about before we get into audit considerations is really about credits, which have always been around but have gotten a little more important these days because of the current situation. So, Bryn?
Sure. So FAR Part 31.201-5, in the simplest terms, is that any credit that you receive back it's recorded within the accounting system so that the government is also getting the benefit that you received. Kind of kicking off from what Susan and Eric were just talking about with CAS coverage, if you are CAS covered, you'll have in the disclosure statement how you handle credits and costs. So how you are recording those credits would need to be consistent with what's in that disclosure statement. If you're non-CAS covered, then you simply just follow the cost principles. A couple of examples of typical credits that we see clients receive. So if you get a purchase discount for buying in bulk, that credit that you receive also has to be shared back with the government. If you have fixed assets, and certainly you're depreciating those over time, but when you go to sell that asset, if the price that you get for that exceeds that net book value and you have proceeds from the sale of that asset, that credit also has to go back to the government and back to the pool. So essentially you're sharing all of the credit you receive back in part with the government. The same with PPP credits, I'm sure many of you will be receiving, and Eric discussed that on this slide now.
Thank you, Bryn. So, we did want to talk about this really briefly because PPP and in the current environment and what's been going on, there would be an expectation of a credit being applied back to your rates if you did receive any amount of PPP. So right now, some best practices when it comes to this: make sure you're continuing to monitor your indirect rates, provisional versus actuals. This would impact when it comes to your cost potentially. It really is dependent on your contracts. And the last piece is document the credits that are applied and make sure that any documentation that you have related to any PPP credits are supported by work papers. And you can go to that if you during your annual incurred cost submission, or any other type of government audit. We didn't want to spend too much time on this because Cherry Becker recently did another webinar on PPP and its impact on government contractors specifically. So if you were not able to tune into that webinar, the slides are on the website. We also are happy to send you the slides. Just please feel to reach out to us after this webinar.
Yep, I think the actual webinar is available on demand, so you can listen to it as well. So let's switch gears and last few minutes just talk about auditors, our favorite subject, not financial auditors, which is what Bryn is, but government auditors.
Yep. So things to just keep in mind and remember that when we're talking about any of these costs that we are taking into consideration, the cost principles, so uniform guidance or FAR Part 31, and really things to remember there are the allowability and the reasonableness of costs, allocability of your costs, ensuring that any expressly unallowable costs are segregated accordingly. recording your direct versus your indirect costs. If you are CAS covered, make sure that you're following your cost accounting standards. And then if you do receive any grants from federal agencies, NIH or DOE, for example, there may be other audits that are triggered, such as a program-specific audit, depending on how much of those federal expenditures you've had in a year. The other thing we're just going to do a quick reminder on was your cost accounting. So we've already discussed at length the base that you're using to allocate the costs and just making sure that that's common and makes sense. We've talked about cost centers, but generally these are a good way to capture costs and certainly can vary based on the company structure. And if they have, if you're a company that has certain work in either field locations, and I know lots of our clients, we have both a home office and a government rate, but taking into consideration if there are any field rates or other locations or divisions that you can think about for that structure as well.
Hey, Brand, do you mind if I
Sure.
Go ahead, Eric.
jump in real quick?
Yeah.
So one thing with the different types of cost principles, if you are receiving, with right now there's a huge push by the government to use third-party auditors, where they will be auditing on behalf of maybe NIH or DCAs contracted out to do cost audits. We also see NASA does this a decent amount, so there's been a big uptick in third-party auditors. But remember, your cost principles follow the type of organization you are. So if you do have grants and you're for-profit, you would still follow FAR Part 31, things like that. Because a lot of times, the auditors, when they're reaching out, just have a list of all these contractors that they have to contact and perform maybe an incurred cost audit for. And that third-party auditor will just send a blanket request out for with a massive request list to the company. And they aren't considering the types of contracts that you have or the who your cognizant agency is. It's just a blanket request. And if you do not know necessarily, what your audit rights are, or if there's some confusion there, you might go through an audit process that might not be necessary. And sometimes these audit requests, these lists are so massive that you can't. Some items might not be applicable, and you can push back. Susan, you told me recently about an example with that you dealt with. Do you want to talk about that for a moment?
Yep, sure. So we've, as Eric mentioned, we have seen an uptick in the use of third-party auditors. And while we sometimes have plenty of things to say about DCA and are critical of DCA auditors in terms of some of the things that they ask for, we have been surprised recently. We've been working with a couple of clients that are having that have DoD. DoD is their primary audit agency, and they are now dealing with an outsourced auditor. And the request list, one client just recently had a full incurred cost audit for 18, and they've been notified, they have a fiscal year end, they've been notified that they will have a third-party audit for 19. And DCA was on the audit entrance conference, but the follow-up list of information that was requested of them, it was so extensive and just, lots of things in there that really we didn't think were appropriate. We did get on a call with them and participated and push back on some of the information requests, and they did agree that they were not necessarily needed. So, we hope that's not a trend, but it's definitely something that we are paying attention to as more and more audits are outsourced.
Thanks. So continuing on with just a couple other audit considerations. So indirect rates really do have a role in the billing and revenue recognition process of cost plus type contracts, and then also in certain circumstances, T&M when a G&A rate can be applied to direct costs other than labor. So recognizing that many companies use provisional indirect rates to bill and then to recognize their revenue throughout the year, typically then you'll see that there's a rate variance at the end of the year when the revenue is really trued up to actual rates. So we do see a lot of times that this rate variance will be reflected as either a contract asset or liability on the financial statements. And then certainly, companies at the end of the contract work to settle the rate variance as part of the contract close. And the last piece that we wanted to touch on here was, just given that labor is the driver of most costs that are incurred and revenue recognized, it's imperative that companies have sound controls over the labor charging process, and that labor is properly recorded as direct versus indirect to the correct contract or project. That's really critical from an accounting and audit perspective. And it's really ensuring that employees understand the importance of timekeeping, and the controls that are surrounding that is pretty critical for any organization, but especially for government contractors.
And we are running short on time, so let's go cover these pretty quickly.
Sure. So the pitfall that we have is at the top. So unjustified allocated costs. Our best practice that we recommend is just document the rationale for your rate structure, your corporate allocations, or any shared services. Your unallowable costs. Best practice, identify those unallowable costs at the point of entry into the system, and also make sure that there's sound training that goes to all employees, especially those involved in your accounting practice. Inadequate audit evidence. So really maintaining that formal supporting documentation of invoices, expense reports, receipts. Keeping that audit evidence is going to be crucial when you're going through any type of audit. And then incomplete documentation. Best practice, any policy, any procedure that you have, ensuring that that is formal and written. And then if you have separate books, making sure that you've got the documentation on that as well. And Eric, I'll let you run through the last audit considerations that we have.
Yeah, so thank you, Bryn. The last thing we wanted to touch on is that, your indirect rates just aren't a accounting function where you might be calculating those for provisional billing or your incurred cost submission or NICRA or F&A rate. They do play a very important role in getting an approved accounting system or an approved estimating system. It is something that could come up and be questioned during those audits. So it's something to really consider. Bryn a few moments ago was talking about good internal controls and labor recording practices. That is something that will be asked about in your accounting system, in an accounting system review for a 1408, or if it's a post award. If that's the case, they'll be wondering, how are you allocating costs between direct and indirect cost objectives, and how does that then end up flowing through and potentially impacting your rates? There's also questions about your allocation of rates within the accounting system. Estimating, they're wondering how are you pulling in your rates when you're using that for pricing exercises. If you don't have any audited incurred cost submissions, or if you don't have any flexibly priced contracts right now, but you are going through an estimating system audit or proposal, there is some type of expectation on having, a computation of your rates. How'd you calculate it? What's the basis? So just wanted to touch on this real quick, that rates do touch these other systems, and it's not just a arithmetic exercise.
Okay, so with that, thank you, Bryn and Eric. Unfortunately, we have run out of time. I do see a number of questions that have come in. There's a couple that I think would be good for us to maybe provide answers to the broader audience. So a couple of them look like they're very specific, situation specific. I'm afraid we're not going to have time to cover those today, but we will follow up with you and try and answer your question. I would like to thank you all for participating today. We have lots of information on our website and other webinars that we put out there, and blogs and things like that. So please don't hesitate to reach out to any of the three of us directly, or if you need help, you can always search our website. Thank you all for joining us today.